Hi, David. Thanks for joining us. So we've got David Neville from First National. David's been in the mortgage industry for 37 years, and we wanted to highlight one of our lenders and go through the home buying journey, essentially, in the mortgage application process. So I thought this was very valuable to add to our series of interviews and the educational portion of it. So thanks for joining in.
Thanks, Matt. I really appreciate you having me today. That's wonderful.
My pleasure. My pleasure. And we have Julia Menard from our residential team. So we'll go through the whole a few questions and answers essentially as we go along. So Julia, do you want to kick it off?
Absolutely. David, thank you for joining us today.
Thanks.
What specific documents should we be gathering from before we apply for a mortgage? So speaking on behalf of a client.
Yeah. So the one thing I would talk about is the essentials, which are a job letter and a pay stub and your down payment documents. I mean, if we'll talk about it in regards to a purchase, a refinance, obviously you wouldn't have down payment documents, but for a purchase, job letter, pay stub, and down payment documents. Where's your money coming from for your down payment on your mortgage? How much do you make, and how do you make your money? Those are the three things.
Very good. And are there any additional documents required for self-employed applicants?
Yeah, and it does depend on what type of self-employment you have. There's two general types. There's sole proprietors, or there are people who own their own companies, incorporated companies. Typically, the standard is know how long you've been self-employed, so some proof of how long you've been in business, and 2 years worth of tax documents to show how much you're declaring as personal income over the last 2 years. Those are pretty standard for self-employed. After that, there's variations, but we'll stick to the standards on this.
Yeah, and on that note, I mean, David, when clients are applying, doesn't matter, who they're applying with, they have to prove that information because they have a regulatory body essentially that governs all of the residential mortgages and
Yep.
can have to hit a certain guidelines and threshold, I guess, when it comes to debt ratios and so on. But we did a credit repair, a video with the Credit Game, which is a credit repair company essentially, which was really great, kind of giving us pointers on how to improve a credit score and so on. But what is First National's typical kind of minimum credit score on a traditional mortgage?
So again, if we look at it from the point of view of a purchase, and most about 50% of all the mortgages I do here in Atlantic Canada are high ratio insured mortgages. So when I'm looking at it from that point of view, typically our absolute bare bones minimum is the 600 credit score. We will look at a minimum 600. Most clients that we're looking at now, the average credit score is very close to 700, which is changed over the years, but right now it's around 700. But there are certain programs that do require a higher credit score. You mentioned self-employed. There is such a thing as, I'm going to use air quotes, stated income here. And with stated income, you need a minimum of a 680 credit score. For people who are using down payment assistance programs from the provinces, it's considered a borrowed down payment. And those are a 680 credit score as well. So there are some variations of that, but 600 is kind of our stepping off spot.
So in a nutshell, the better the credit score, the better chances of having an approval, obviously, right? It's one of these things that you want to keep an eye on.
100%, 100%.
Yeah. How long should I be in my current job before applying for a mortgage, David?
So the general rule is that we want them in their job past their probationary period. However, I've done many mortgages for you guys as well, where clients are still in their probationary period. If it's a career job that they're in a role, they're working for the government, or they're working for healthcare, or they're a teacher, or they're a professional of some sort, or a career associated job, then a lot of times we can get past probation for a lot of clients. Now, I will put an asterisk in there. New to Canada notwithstanding, if we have to use the new to Canada program, they have to be past probation but for everybody else, it is a past probation. But like I say, lots of times we can get exceptions to that, so don't let that stop you. Talk to your mortgage broker and ask the question.
And on that note, when you are looking at having an exception, I suspect that most exceptions that are merited would be somebody that's switching from one career going into a better position, a better job, but not necessarily somebody that's leaving a position and going into a brand new industry, right? Like you'd want some continuing.
Yes, exactly. You're in the same line of work. People change jobs all the time. We get it. And but if you've made a career change into a different line of work, yeah, we definitely want you past probationary period.
Super. Thank you.
Very good. Are there any benefits, David, in being pre-approved for a mortgage?
I have sung the praises of a pre-approval for a very long time. I think it is a absolute necessity in the home buying process for a lot of reasons. Especially in the marketplace we're in right now. And if you don't mind, I'm going to refer to my notes that I put down here so I don't go off topic too far. So it is a hedge against rate increases, especially in a volatile rate environment. And a lot of people think we're in a rate environment where rates are going down. We are not in that environment. We're in a volatile rate environment. Rates could go up or down at any time. We are not seeing trends that definitely dictate rates are dropping. So what does a pre-approval do? Again, using our premise that it's a high ratio purchase, typically a pre-approved rate is slightly higher than what we're offering on what we call live deals. So you're actually making an offer on a home and buying it. It's slightly higher. What that gives you, it gives you a dollar amount that you can shop for, because we'll pre-approve you for a certain dollar amount. And when you come to a mortgage broker like yourselves, you're going to give the client their absolute maximum that they can shop for. And that rate that's associated with that. If rates go up, your client is guaranteed that rate. If rates go down, we're going to give them the lower rate of the two. So it really is a hedge against inflation. And I think it is a great shopping tool for your clients. It makes it so much easier for them to know I'll call it the box that they're in as far as, the mortgage amount that they can get, because you're pre-approving them for the maximum.
Super. I love this. And especially like we often have calls and people are putting in an offer and they haven't done a pre-approval. So we have to have, a much longer time frame in getting an approval done, because we need to gather the information, gather the documentation, validate all the information, do the credit check, submit it, and so on. So I'd be safe, I guess, to say that you can get an approval faster when you have a pre-approved client essentially is in your system.
Yes, you can, because we've already vetted half the process at that point in time. We know the client fits the box. You've already gathered documentation for income. You know what their down payment is. We just have to verify those things, and away we go.
Super. And you guys are actually looking at, so it's not just a rate hold, you're actually going through the application and kind of a review or an initial review, I guess.
Yeah. Yes, we are.
Yeah, perfect. Excellent. So what factors influence the interest rate? Like maybe if you want to talk about, in like insured mortgages where you need, a CMHC or a Sagen or a Canada Guarantee versus a conventional mortgage when there's no insurance in the background. Maybe just if you want to kind of talk about it a bit.
Yeah, again, it does vary for a lot of things. First of all, is loan to value. So if it's a purchase, how much down payment are you putting down? Whether it is insured or not insured, whether your client is paying the insurer's default insurance program premium or not. Then you get into purchase versus refinance. That will change the rate as well. And credit score does have an effect on this, because sometimes we offer a better rate in certain circumstances to clients with a higher credit score. Lower credit score gets a different rate. So a lot of those things. So standardly, somebody who's taking an insured mortgage, putting less than 20% down, is going to probably get the best rates available. But with that rate comes the requirement to pay default insurance premium, which can be up as high as 4.5% additional on what your what you're borrowing. But it's a means to an end, and it does give you the best rates available in the market. When you're putting 20% or more down, you don't have that default insurance, but the rates are slightly higher for the clients. So, and the same for a refinance. It's a maximum of 80% of the value of the property. So your client is getting a little higher rate, and the rates are pretty good. We're all spinning around 5% right now, either side of it. So they're decent rates right now.
Yeah, and that's interesting when it comes to loan to value. I've been in the mortgage industry for 20 years now, and we've seen so many different changes where there was no, the rates weren't driven if it was insured or not. Like it was like everything could be insured, whether it was a refi or purchase and so on. So it's interesting what's happened in the mortgage marketplace in the last few years. It's probably
about the last, since 2016, this all changed, and I won't go into all the boring details that your customers may not be interested in, but definitely the landscape of the lending industry changed in 2016, and it definitely made us as a lender figure out, how we're going to lend money differently at that point in time. So yeah, it's slightly more expensive for, money that's not insured. So that's where the benefit comes from.
Yeah, and sometimes I've had some comments of clients thinking that the rates are going up. Essentially, the lenders are making much more money, but obviously the cost of funds is going up. So there's always kind of a margin in there, but it's not, when the rates were 22.75, they weren't making 22.75 margin. It was just the cost of funds had gone up, right? So it's interesting. Yeah.
And a lot of customers are being misinformed. While we have a moment to talk about this, I find a lot of customers are being misinformed about what really is affecting rates. And when we talk about the Bank of Canada rate, that has little to nothing to do with fixed mortgage interest rates. It only has to do with adjustable or variable interest rates. And just because the Bank of Canada drops a rate doesn't mean that your fixed rates are going to change. Fixed rates are very, very, there's bond yields, CDORs, spreads, yields, tons of things in here, and that really do. And unless you're in, a finance or economics major, that most of this stuff goes right over my head. So, but I do know that, to your point, Matt, cost of funds is something. It costs us a certain amount, and we have to make something over and above that, because we are a business that has to make money.
Very good point, and that's a common misconception that we see a lot. So yeah, thanks for adding that in. Much appreciated. So on that, any special programs that First National really excels in? Like, is there maybe talking about even Purchase Plus, which I think is sometimes an underutilized product that clients don't know about.
Yeah.
They buy a house essentially, and then they come back, they want to do improvements, but they're not at that 80% loan to value equity percentage, I guess. So maybe just if there's a few key products that you can.
High ratio purchases, like I said, about half of our mortgages are high ratio purchases. Beyond that, in Atlantic Canada, it's kind of an interesting stat, because across the country, these things are different. But in Atlantic Canada, 18 to 20% of all the mortgages that we do are Purchase Plus improvements. Why? Well, one of the main reasons is it's one of the oldest parts of the country, and our housing stock is older, and a lot of times it's dated. And clients are looking at purchasing a home, and in your market, I know Riverview, a lot of the houses in Riverview, the main subdivisions over there, were built in the 50s and the 60s, and a lot of times they were purchased by a young couple, and they raised their family there, and now they're moving on and downsizing and selling that property, but it's still set in the 60s. And that's what Purchase Plus improvement really does well, is it takes that home and brings it up to a more modern stance. You can put things like, a new kitchen and new flooring. Flooring is the #1 improvement that people do on homes. Just a lot of people guess it's something different. No, it's flooring right now. It's the biggest thing. New windows, reshingling a roof, putting new doorway, putting new kitchen, new bathroom, all of those things where you can take that home and bring it up to today's specs, and you got a great home with great bones, as they say, to quote a couple of shows from HGTV, and then you're bringing it up to a modern standard. And it's one of the best programs that we have right now.
And that's interesting because, and if you do it right, and if you do it at the time of purchase, you can finance 95% of the purchase plus improvements. But if you come afterwards, you're limited to 80% of the value of the house. So so it's one of the things that you want to work with somebody that's experienced, that's going to guide you into that, having that right product initially.
And we can increase the value of the property by 20%, sometimes even more. So it's a great way to do it. You know, I've seen improvements of 20, you know, we've done exceptions for 23, 26%, well over $100,000 in improvements to a home. And it's just taking that home and taking it from average cookie cutter to really nice and very desirable, and the resale value goes up on it exponentially.
That's amazing. And when you have a short, like there's, you know, a shortage in supply, I mean, that's where if you can't find your exact home, you can kind of customize it to bring it to exactly what you want, right? Instead of building from brand new.
For a cost that is probably a lot less than buying a new construction turnkey property right now.
Very good point. Yeah.
Yep. Yeah. Beyond that, new to Canada, we excel in new to Canada. The amount of immigration that we have into Atlantic Canada was expected, and it's being very well received. We are looking at people coming from other countries immigrating into Atlantic Canada because the wait time to get their permanent residency status is faster. They're fast-tracked in a lot of areas of Atlantic Canada. So it's a wonderful thing. We see a lot of new to Canada clients, new Canadians coming in. You know, they're here on a work permit. They're got their permanent resident status, and they're buying their first home. It's a wonderful program, and it really does help your clients out. Yeah, like I say, it's gone up a lot over the last little while. Huge increase in that product.
Yeah, and I think there's a great opportunity in Atlantic Canada because home ownership is not a reality in every parts of the country. It's, you know, it's out of it's just not affordable for a lot of folks essentially when you're looking at different parts. So yeah, good for us in Atlantic Canada.
Yeah, exactly. And then beyond that, the only other product I would say is for self-employed clients. I did do the air quotes and say stated income earlier. That's a great product where your client can put as little as 10% down and buy a home, the personal residence, and maybe their income declared to the government is not as high as they would need, but we know they're making money, their business is making money, and it's a great program. And I know, Matt, you're all over that. You know that product inside and out, and it is a great program, and we do it well. So
absolutely. No, and it is, I mean, for self-employed, working with tax professionals and so on, it's you want to minimize your income obviously and not pay more taxes that you need to, but it's great that you guys have products that's going to help these self-employed borrowers. Absolutely.
For sure. That's about it on those.
Super.
Fantastic. David, what's the typical timeline from application to closing?
So when I answered this question, I actually calculate this just for my own stats. And the average deal here in Atlantic Canada takes 51 days to close. Now, it doesn't take 51 days to close. It's on average, that's how long it takes to close. Some people have a purchase that they're not ready to close on for, 3 months or whatever. So, but how quickly can we do it is another part of that question. So it's average 51 days. We've done deals a lot quicker than that. We've closed deals in a week before. I don't want to make that the standard because that is not realistic, because there's outside forces that do complicate these things. But if all the moon, stars, and the sun line up, we've done deals week to 10 days without a problem.
Oh, that's great. Yep.
That is terrific, actually. And I've experienced some of your speedier returns for our files, which is terrific and much appreciated by us and our clients.
Well, sometimes clients are dealt a hand that they don't necessarily want to be dealt, and things happen, and oftentimes a mortgage broker will step in and ask First National to help them out, and we will, and we've kind of thrown things together really quickly and to help the clients out. It's you know, again, I don't want your clients think that, you know, 5 days before they close on the purchase, they can show up at your doorstep and say, hey, I haven't seen anybody yet, here's my purchase agreement. It's, you know, you want to see your mortgage broker early, communicate with them often, but, you know, can we do something quickly if they've been dealt a hand? Absolutely, we can.
Very good. And what are the steps involved in a mortgage approval process?
So again, going from the premise of it's a high ratio insured mortgage, they come to you, they provide you with their personal details, their credit application, job letter, pay stub, down payment. You submit that deal to First National. Typically within 24 hours, we'll have that deal decisioned for you. We have to send it to a mortgage insurer who would also review the deal and approve it. Then we issue the commitment. So typically it takes about 24 hours on average to get a commitment out to you. Again, outside forces notwithstanding. But yeah, that's basically it. Then once we've got the approval for you, we then review the documentation, make sure the job letter is accurate, the pay stub lines up, the down payment is complete. We call their employer to ensure that the information on the job letter is accurate. That's part of the due diligence that we have to do. And then once that is done, we get what's called a broker complete, and everything that you've provided with us is reviewed. Then we instruct the lawyer and that's closing the deal for your clients. And then the lawyer provides the balance of the documentation and we fund the deal. Typically, and it's a good time to mention this, typically, you know, the day of closing, as long as the solicitor has documents to us prior to the day of closing, you've signed before the day of closing and we've reviewed them and there's no missing documents, typically your mortgage funds before lunchtime on the day of closing.
Super, that's
Very
great.
good.
I've seen so many people sometimes just, you know, line up their moving truck just early in the morning, especially in trying to close that day essentially, but it's closing at 5 o'clock. So it's one of these things that we try to get clients to close on a Thursday or not on a Friday. If something happens that it does not close on the day of it, then you're not sitting in a U-Haul for a weekend.
Yeah. My busiest day of the week is always Thursday. So
super. Yeah. So on that, what do you see as the common mistakes that applicants make or that can hinder their mortgage approval, and how can they avoid these mistakes? Like what do you see, I guess, that would be the I would guess that probably better than 50% of people don't know exactly how much they make in a year. They don't know their income. They know in general where their income is, but they don't know what their income is. So know your income. How do you know your income? Look at your pay stub, look at your year to date, get a job letter from your employer that states what your income is. It sounds like a silly thing, but trust me, it happens all the time. Know the amount of your down payment and if that money is available. So many times I see heartbroken clients when they go to access money for a down payment and realize it's in some sort of a vehicle that cannot be cashed out. Locked in RSPs, for example, GICs that don't allow you to cash them out until maturity, different things like that. So knowing where your money is and having that money saved for at least 90 days. And when I say money saved, I mean in a bank, not in a shoebox. I make a joke, but it's true. Unfortunately, we have a term for it. We call it mattress money, money that's been hidden in a mattress. Unfortunately, the world we live in doesn't look favorably upon money that is not in a financial institution and is able to be tracked and allotted for over a period of at least 90 days. That's one thing. And one of the biggest things I can tell you is when you put your money into a saving vehicle of some sort, leave it there. Just leave it. Don't move it around.
it will complicate your approval process. It will muddy waters very quickly if you don't just leave your money in one vehicle. I'm not saying you have to have it in a checking account or savings account, but leave it in a vehicle. One of the pitfalls that I find the biggest is a client will have, for whatever reason, multiple accounts. They will move money from one account to another, to a third, to a fourth. I had one the other day that was 7 accounts, and they kept moving money around just to gain literally a few cents of interest. It's not worth it, folks, because when I'm looking for a 90-day history on 7 accounts, how many pages of paper is that for you and Julia to review? That's hundreds and hundreds and hundreds of pages. And it takes a lot of time.
And that's a good point. And we've seen so many situations where, you know, clients just don't know, but I've seen, you know, situations where the individual had the money saved up and they moved it to a line of credit just to save interest on the line of credit. Then it becomes a borrowed down payment because they're taking it from the line of credit, and it's no longer own resources. It's a borrowed down. So it's a different approval, essentially, and different kind of risk level. So yeah, those are great suggestions. Yeah.
Yep. Excuse me. How will changes in my financial situation, like a new job or a major purchase, affect my application process?
It won't help. Unfortunately, it won't help. So your credit application and your credit report are a snapshot of time, okay? Or a snapshot in time, I guess that's the best way to say it. It is where you are at that moment, okay? Where your job is, where your credit is. Your credit score is not a static number, it changes. And when you borrow more money, when you take out more credit facilities, and I'm going to talk about this straight up, when you buy your appliances and you finance them on a 90-day, no interest, no payment plan at your local furniture store, that still affects your credit, and it's still a payment that we have account for, even though you have it for 90 days with no interest and no payment. That is one of the biggest problems I see, is that, you know, you've come back to us and something's changed and we need an updated credit report, and all of a sudden we see another debt on there, and your client who did qualify, you know, a week ago now doesn't qualify anymore. And it really is something, folks, if I can speak to the customers directly, don't do it. You know, just don't buy a car, don't change jobs, don't finance your appliances if you can all afford not to. Just keep it status quo, or have your appliances purchased beforehand, so you guys, your mortgage broker, can take that into consideration. It is again, we want that snapshot in time to stay as intact as possible until you actually close on that house.
So on that,
is that a good answer? I hope it's a good answer.
It's a very good answer.
Good.
So on that, David, I just wanted to talk about First National for a minute. So you guys are one of the Canada's largest non-bank mortgage lender. So you guys would be called what we call a monoline lender that strictly do mortgages, essentially. How long has First National been in existence?
This is our 36th year. We celebrated our 35th year last year. We are, I'm going to correct you, Matt, we are the largest non-bank lender in Canada.
The largest. Congrats.
Yeah, the largest. So yeah, we've been around for 35 years, from a very small company that had paper applications and fax machines to a company with well over 1,000 employees coast to coast right now. So including here in Atlantic Canada, where we employ, I think our staff is running around 13 people in Atlantic Canada right now. So good representation here locally.
Super. Yeah, and it's been, First National has been amazing to us and a great lender partner essentially of ours. So it's it's a pleasure dealing with you, obviously, in the way that you guys do business. I know that you guys are fast. You have the knowledge and the wisdom essentially to put these in place and to move fast on what the customer needs, I guess. So anything else that you wanted to kind of pitch in on First National?
One of the biggest things that that, you know, is a cornerstone of our business is service, period. Like everybody I deal with is, you know, has the same mentality of service, service, service. We, you know, rates come and rates go. You know, we're not necessarily always, you know, we want to have great rates, absolutely, but great rates at what cost? You know, sometimes the best rate on the market comes at a price that can't be measured in percentage points. It comes at a price that is measured in time, and time matters right now. You mentioned it, you know, a reduced inventory of homes. You want to make an offer on a property, you need that, you need quick. And that's what First National does is, you know, we're fast, we're efficient. I always say we're a big machine, and being a big machine is not a bad thing because we've got it down. And, you know, mortgage brokers know that, and that's why we are the number one, you know, broker lender in Canada, monoline as you call us in Canada. It's because of the service, pure and simple.
Yeah, and you guys have a great portal too. I gotta just chime in on the portal where you can kind of change your payments and so on. So it's great that you guys have adopted with technology, and then you can, you know, pull your mortgage renewal statement or change your payments or do, you know, an extra prepayment and so on.
Basically, Matt, the client can do everything in that portal other than requesting a payout on their mortgage. They can change payments, they can do all their prepayments, change the frequency, update their fire insurance, update their pre-authorized payments, they change bank accounts. Everything can be done through that portal. It is, and if it can't be done, there's a chat feature in it that they can talk to one of our service reps that's available during the day. So yeah, I think the My Mortgage portal is hands down the epitome of how we put service first and foremost for our clients.
Super. Excellent. Well, thank you. Thanks, David Neville from First National, for taking the time. And thanks, Julia, from our residential team. So thanks for watching, and thanks for your time.
Thank you, guys. Appreciate you.
Thank you.